Let me ask you something uncomfortable. What if the number you've been building toward, that retirement nest egg, that savings target, that mental image of the life waiting for you on the other side of work, what if that number is wrong? Not because you miscalculated, not because you didn't save enough, but because the financial era that created that number is ending. This isn't a crash prediction. I'm not here to scare you. But Vanguard, one of the most measured, most methodical, least dramatic institutions in the history of American finance, has revised their long-term return forecast. And the revision is significant enough that if you're between 45 and 75 right now, it deserves your full undivided attention for the next 10 minutes. Stay with me here. For most of the last 4 decades, the American investor enjoyed something remarkable. The S&P 500 delivered average annual returns somewhere between 10 and 12%. That's not a myth, that's what happened. And those returns shaped everything. The calculators, the Monte Carlo simulations, the 4% rule, the conversations your financial advisor had with you, the number you have written in the back of your mind right now. All of it was built on a foundation of double-digit growth. And for a long time, that foundation held. But Vanguard's 2025 capital markets model, a forecast they publish every year using real economic data, is now projecting U.S. equity returns of somewhere between 3 and 5% annualized over the next decade. 3 to 5%. Let that land for a moment. Not 10, not 12, not even 7 or 8. 3 to 5% from the very asset class that most American retirement portfolios are built around. Now, here's what makes this different from the usual doom and gloom you'll find on the internet. Vanguard isn't guessing. They're not being political. They're an institution that manages over $8 trillion in assets. When they shift their forecast, they do it quietly, methodically, and based on math. And this time, the math has shifted, meaningfully. Let me show you why. When stock prices rise faster than corporate earnings for a long period of time, which is exactly what happened through much of the 2010s and into the early 2020s, something called the cyclically adjusted price-to-earnings ratio, or CAPE, climbs. Think of it this way. You're paying more and more for each dollar of profit a company earns. That's fine when you're in a growth environment, but it compresses future returns. You've pulled tomorrow's gains into today's price. Right now, U.S. equity valuations are historically expensive. Not 1999 bubble expensive, but expensive. And that premium has a cost, and the cost gets paid in the decade ahead in the form of lower returns. This is basic financial physics. It's not pessimism, it's math. And Vanguard isn't alone. Goldman Sachs published a similar analysis suggesting U.S. large-cap equities may average around 3% annually over the next 10 years when adjusted for current valuations. Goldman called it a lost decade scenario that investors need to plan around, not ignore. Now connect the dots. You have two of the most institutional, most data-driven, most respected firms in global finance pointing in the same direction. And that direction says the era of easy American equity returns may be behind us, at least for the foreseeable future. But here's the twist. This doesn't mean all markets are stuck. Vanguard's same forecast actually sees more opportunity outside the U.S. International developed markets, think Europe, the U.K., Japan, are projected at 7 to 9% returns. Emerging markets potentially higher. Value stocks, which spent most of the last decade getting beaten badly by growth stocks, are showing up in multiple institutional forecasts as genuinely attractive again. So the playbook isn't stop investing. The playbook is stop assuming America is the only game in town. That is a meaningful shift, because if you're 55 years old with a portfolio that's 80% U.S. equities, which is very common by the way, your expected return over the next decade may look considerably different from what you've been modeling. And if your retirement plan was built assuming 7 or 8% average annual returns going forward, you may be operating with a map that no longer matches the terrain. Now, let's talk about something that doesn't get enough attention in these conversations. It's called sequence of returns risk. And for people in their 50s and early 60s, it may be the most important financial concept you've never heard anyone fully explain. Here's the idea. Imagine two investors, both retire at 65 with $1 million. Both average the same return over 20 years, let's say 5% annually. But the first investor has a string of bad years right at the start of retirement, followed by good years later. The second investor has good years first, bad years later. Same average return, wildly different outcomes. Why? Because in retirement, you're withdrawing money. You're not just watching a number grow, you're pulling from the pile every month. And when you pull from a declining portfolio early in retirement, you sell shares at low prices, shares that can never recover and compound for you later. The math that worked beautifully during accumulation turns against you during distribution. This is why a lower return environment is especially concerning for people in their 50s and early 60s right now, or who have already recently retired. It's not just about lower growth, it's about the vulnerability that comes with drawing down a portfolio in an era of compressed returns. The two problems compound each other. Stay with me here because this next piece matters. The famous 4% rule, the idea that you can safely withdraw 4% of your portfolio each year and not run out of money over a 30-year retirement, was developed by financial planner William Bengen in 1994 using historical market data that included those strong double-digit return periods. Morningstar revisited the rule in recent years and, based on lower projected returns, suggested that a safer withdrawal rate in today's environment may be closer to 3.3%. What does that mean in practice? On a $1 million portfolio, the 4% rule gives you $40,000 a year. At 3.3%, that's $33,000 a year. That is a $7,000 annual difference. Over 20 years, that gap is significant, both mathematically and emotionally, and many people haven't adjusted their mental models to reflect this change. Now, let's zoom out and look at the economic backdrop, because you can't separate your portfolio's future from the economy it sits inside. GDP growth in the United States has been slowing, not crashing, slowing. The post-pandemic sugar rush of stimulus spending has faded. Consumer debt is at record highs. The personal savings rate has dropped dramatically from its pandemic peaks. And while the labor market held up surprisingly well through 2023 and 2024, there are structural forces building. Automation, AI-driven displacement, demographic shifts that economists believe will create genuine unemployment pressure in the latter half of this decade. Inflation is the other piece. The Fed raised rates aggressively to fight inflation. That worked, partially, but inflation has proven sticky, meaning it doesn't go away cleanly. Housing costs, insurance premiums, healthcare costs, these are still rising faster than the Fed's 2% target, in ways that directly affect the people watching this video. Because here's the truth. Your inflation rate as a retiree or near retiree is not the same as the headline CPI number. Healthcare spending for people over 65 is inflating at roughly twice the general rate. That creates a purchasing power problem that standard retirement modeling often underestimates. So you have slower growth, sticky inflation, and compressed equity returns all arriving at the same time. That's not a catastrophe, but it is a reckoning. Now, and I want to be fair here, there is a thoughtful contrarian case worth hearing. There are serious economists and strategists who argue that artificial intelligence represents a genuine productivity revolution, that the productivity gains from AI adoption could surprise the market to the upside, that corporate earnings could accelerate faster than current models assume, that the innovation cycle we're entering could do for the 2030s what the internet did for the late 1990s, but with more durable, economically real results. That case is not crazy. It's made by smart people. Jeremy Siegel at Wharton has argued consistently that stocks remain the best long-term vehicle for wealth building, and that pessimistic forecasts have historically underestimated American corporate adaptability. Maybe they're right. I genuinely don't know, and neither does anyone else. But here's the thing about retirement planning. It's not gambling. You don't plan for the best-case scenario. You plan for the realistic scenario and build in margin. If the optimists are right and returns come in at 8 or 9%, your conservative plan looks brilliant. If the optimists are wrong and Vanguard's 3 to 5% forecast holds, your conservative plan protects you. The asymmetry only works one way. Let's talk about the human side of this for a moment, because financial math is only part of the story. The model of retirement that most boomers and Gen Xers grew up watching, the hard stop, the gold watch, the Friday afternoon goodbye party, the Monday morning sleeping in, that model was built for a different era. It was built for pensions, for defined benefit plans, for Social Security that replaced a meaningful percentage of income. Most of that infrastructure has been quietly dismantled over the past 30 years. What research is increasingly showing, and what financial planners who work specifically with people in their 50s and 60s are seeing, is that gradual retirement is often both financially smarter and psychologically healthier than the cliff edge model. Think about what working even 2 more years, part-time, in something you find meaningful, actually does to your portfolio. It does 3 things simultaneously. It allows your investments to compound longer without withdrawals. It reduces the number of years your portfolio needs to sustain, and it keeps you engaged, socially connected, and purposeful during the years that research shows are most vulnerable to the mental health challenges that can follow sudden retirement. I'm not saying work forever. I'm saying the binary of fully working versus fully retired is a false choice that may be costing some of you more than you realize, financially and emotionally. Now, connect the dots one more time. If returns are lower than expected for the next decade, and withdrawal rates need to come down, and inflation is eating into purchasing power faster for your specific expenses, then the levers available to you are not just investment allocation. They include when you retire, how you retire, what you do in the early years of retirement, and whether the lifestyle you've imagined actually requires as much as the number in your head suggests. So what does the practical version of this look like? It looks like revisiting your allocation with fresh eyes, not with the instinct to panic sell US stocks, but with genuine openness to international diversification, value-tilted funds, and assets that Vanguard's own model currently scores as having better forward return potential. It looks like having an honest conversation, either with yourself or with an advisor, about what your actual withdrawal rate will be and whether it's been stress tested against a 3 to 4% return environment rather than a 7 to 8% one. It looks like understanding sequence of returns risk well enough to have a cash buffer or a bond ladder covering your first few years of retirement expenses, so that if markets have a rough stretch right after you retire, you're not forced to sell equities at the worst possible time. And it looks like questioning the timeline, not in a defeated way, in an empowered way, because the people who navigate this shift successfully won't be the ones who panicked, and they won't be the ones who ignored it. They'll be the ones who looked at the new terrain clearly, made calm adjustments, and kept moving. Here's how I want to leave you. The financial era that shaped most of your saving and investing life, the era of relatively easy double-digit returns, of watching a 60-40 US portfolio build wealth almost automatically, that era taught you something valuable, that patience and discipline and consistent investing works. That lesson is still true. It will always be true. What's changed is the specific math, the specific returns, the specific allocation that expresses that discipline most effectively in the decade ahead. Vanguard didn't change the playbook because everything is falling apart. They changed it because the data changed. And your job, our job, is to read that same data with clear eyes, resist both panic and complacency, and make the quiet, intentional adjustments that protect the life you've been building toward. You've spent decades doing the hard thing, saving when it would have been easier to spend, staying invested when it would have been easier to sell. This is just the next version of that same discipline, a recalibration, not a retreat. The playbook changed. Now you change with it.